So inflation. It's a word that gets thrown around all the time, right? On the news, by politicians. It's this invisible force that seems to be constantly nibbling away at the money in our pockets. But what is it really? Let's take a few minutes and actually break down one of the most powerful forces shaping our world.
Come on, admit it. At some point, probably when you were a kid, you dreamed of having a machine that could just print money. An endless supply of cash. Think of all the stuff you could buy. But there's a catch, isn't there? If you and everyone else suddenly had stacks of new money, what do you think would happen to the price of everything?
And that little daydream, it actually gets us right to the heart of the matter. The official definition is a sustained increase in the general price level. But in plain English, it just means your money buys less than it used to. Your purchasing power, the real-world value of your cash, is going down.
Okay, so far, so simple, right? Well, that simple idea has fueled one of the biggest, longest-running arguments in all of economics. And I mean long-running. We're talking centuries. This isn't a new puzzle. People have been trying to figure this out since the days of the Roman Empire. Seriously, this is not a new headache. Roman emperors did it by secretly mixing cheaper metals into their silver coins. Fast forward to the 16th century, and a flood of gold from the Americas caused what's called the price revolution in Europe. And of course, we've all seen the pictures of people in 1920s Germany using wheelbarrows of cash to buy bread, or heard about the brutal stagflation of the 1970s. The story changes, but the theme stays the same. For a huge chunk of the 20th century, the debate was basically a heavyweight boxing match between two camps. In one corner, you had the monetarists. Their argument was simple. In the long run, inflation is all about the money supply. If you print money faster than your economy grows, prices will go up. End of story. In the other corner were the Keynesians. They focused more on the short-term messiness of the real world. They said, hey, things like unemployment matter, because wages and prices don't change instantly. They can be sticky.
And if you want the monetarist view boiled down to one single powerful sentence, you can't do better than this quote from the Nobel Prize-winning economist Milton Friedman. He famously said, "Inflation is always and everywhere a monetary phenomenon. It's about as direct as you can get, putting the responsibility squarely on the money supply."
And you know what? Don't just take his word for it. Look at the data. This chart is pretty stunning. It looks at 17 advanced economies over a 45-year period. And the link is crystal clear. The countries that had higher growth in their money supply also had higher inflation. Over the long haul, that relationship is tough to argue with.
So, who won the great debate? Well, in a weird way, they both kind of did. Modern economists have basically taken the best ideas from both camps and synthesized them into a more complete, unified theory. Let's check out what that looks like today.
Most economists now think of it as a triangle of forces. First up, you've got demand-pull inflation. That's the classic monetarist idea. Too much money chasing too few goods. Next, there's cost-push inflation. This happens when the cost of producing things goes up, maybe because of a supply shock, like a war, or a sudden spike in oil prices. And finally, the really tricky one, built-in inflation. This one's all about psychology. If we all expect prices to go up, we start demanding higher wages, and businesses start raising prices, and it becomes a self-fulfilling prophecy.
Okay, that's the theory. But let's get real for a second. Why should you actually care about any of this? How does this economic force actually hit your wallet? Well, here's the twist. It's not all bad. On the one hand, yeah, the downsides are pretty obvious, right? It chews up your savings, makes it hard for businesses to plan for the future, and can even lead to hoarding. But here's where it gets interesting. A small, steady amount of inflation can actually be a good thing. It can help labor markets adjust, and it encourages people and companies to invest their money rather than just letting it sit there and lose value. And most importantly, it gives central banks some breathing room, some room to maneuver to fight off recessions. So if it's got good sides and bad sides, how in the world do you control it? How do you get just enough of the good stuff without letting the whole thing spiral out of control? Well, that brings us to the modern toolkit for taming the beast.
In most developed economies today, this massive job falls to one group: independent central banks. Their main weapon is something called monetary policy. You can think of them as the economy's thermostat. Their job is to turn the temperature down when things get too hot with inflation, and turn it up when the economy gets too cold.
So what's in their toolbox? 3 main things. First, inflation targeting. They literally just tell everyone, hey, our goal is 2% inflation. That helps manage those expectations we talked about. Second, and this is the big one, they adjust interest rates. Raising rates makes borrowing more expensive and cools the economy down. Cutting them does the opposite. And third, they use something called open market operations,
which is a fancy way of saying they buy and sell government bonds to put money into or take money out of the system.
So here's the bottom line. The goal isn't to get rid of inflation completely. The goal is to manage it. It's a constant, delicate balancing act. You're walking a tightrope between keeping the economy growing and making sure prices stay stable. Push too hard in one direction, you could cause a recession. Let things go, and you could wipe out people's savings. It's a tough, tough job.
And that brings us right back to today and to the future. The basic economic principles we've talked about are timeless. They're centuries old. But the world keeps throwing new challenges at us. As we face totally new kinds of supply shocks from things like climate change or massive technological shifts, it makes you wonder, doesn't it? What's going to be the trigger for the next great inflation?